Hello all, and thank you for attending week 4 of BFSG's 4-week summer webinar series, today covering the 7 pillars of financial planning. This session, being the last, will hopefully bring the series together, adding a bit on tax planning, asset allocation, and a case study throughout to highlight a few key considerations. A few housekeeping items. There's a Q&A box in the Zoom menu. This is distinct from the chat box. Please type all questions into the Q&A box, and we will either type a response back or address them all at the end of the 30-minute presentation during a live Q&A for all participants. For compliance purposes on a live and recorded webinar, we will not be unmuting lines, so please type all of your questions in. Should your questions be more personal in nature, we will be providing all of our contact information at the end of the webinar and encourage you to reach out personally rather than asking personal questions on a live and recorded webinar. There will be live registration links for full replays if you'd like to revisit any portion of this presentation within about 30 minutes following the end of our session today. With that, let me pass it over to our panelists for introductions. Keith.
Great, Chad. Thanks a lot. Well, first of all, I'd like to thank everyone for attending today's webcast on the 7 pillars of financial planning. Just wanted to begin with a quick statistic here. It's estimated that 70% of the wealth in this country is controlled by the baby boomers. Their number one fear as they reach retirement age is running out of money. So everyone on this call, as investors, what can we do preparing for retirement to ensure ourselves we've built that solid retirement foundation? Well, I personally feel the answer lies in the financial planning process, specifically the 7 pillars of financial planning. So my name is Keith Johnson, and I am a senior education specialist and financial planner with Benefit Financial Services Group. I'm joined by Paul Horn. He's also a senior financial planner and actually co-presenter of this webinar today. Mark Blom is also on the line with us, and he is a senior financial planner with BFSG as well. So we're going to begin today with an interactive poll. I'm going to turn this back over to Chad, and he'll kick off the presentation with a poll that talks about life and retirement.
Thanks, Keith. So this is the first of what we'll have 4 interactive polls today in the next 30 minutes. So hopefully for all of you engaged on the computer today, and we're going to launch up and a box should pop up on the top of your screen. The first is just to gauge the audience. It is multiple choice, so select all that apply. And just what does retirement look like for you? I've launched polling. I'll leave it up for about 20 seconds. Cool. With that, let me close polling, and I will share results with the group today as well. And you can see you have a huge mix, over 70% saying traveling the world, almost 80% saying more time with family and friends, get big groups saying volunteer, playing golf every day, and some of those just want to binge Netflix all the time. So with that, let me share results and put them on the screen really quickly. And then with that, I'll pass it back to Keith and Paul.
Thank you so much, Chad. Well, I'm glad to see here that the answers here was not binge Netflix. Glad to see that people are wanting to get out, and that makes a lot of sense right now, especially given everything going on with us today. For sure, traveling and spending time with family and friends are definitely the 2 most common answers that we see with that poll. So let's just take a moment here at the 7 components of financial planning and really take a closer look at what these pillars are. When we're doing a financial plan, it really begins with retirement income needs. This is just trying to determine how much money you need to be able to retire and live the lifestyle that you want to live. And to do that, we have to take a closer look at your expenses and debts. Obviously, the higher these are, the more difficult it is to retire. Along the way, we're going to try and grow your money as well, and we're going to do that through looking at taxes and your investments. But aside from just trying to grow the assets, we need to protect them as well. And that is done by looking at risk management and estate planning. And then with all this factored in, what we do is we're going to put it together, a distribution and income plan for you. And this is really where the rubber meets the road for your retirement plan.
Thanks, Paul. So to illustrate these 7 pillars today, we're going to take a look at a case study. So meet Barbara and James. They came to us looking for help. Barber works for the state of California, and earns about $57,000 per year, and she is looking to retire at age 64. However, when we initially met with them, she was extremely anxious about whether or not James and she were even in a position to retire. I mean, to the point where the couple, they were tracking every single penny going out the door. No eating out, no vacations, no nothing. Take a look at their investable assets here. Barbara is currently contributing $12,000 to her 401k. It also has a 457 plan to contribute to. So a 457, that acts much like a 401k plan, but it's only available to state and local government employees. James is an architect in the private sector, earning $156,000, also looking to retire at the same age. He is currently contributing $12,744 to his company's 401k plan. Couple own a home. It's valued at $810,000, and they have a mortgage balance of $233,000. So in addition to their retirement plans through work, they also have a brokerage account valued at $461,000. You'll notice they're currently paying $4,800 per month on the mortgage. For a lot of folks, that might seem like a lot. The reason they're putting so much towards a mortgage is because their youngest child just graduated from college, and they've been paying along the way, so cash flow has been freed up. And their number one goal in all of this is to have that home paid for by the time they retire. So that's a big concern for them. And at this point, what I'll do is throw it back over to Chad. We're going to talk a little bit about some of the bigger concerns throughout retirement.
Thanks, Keith. So again, very quickly, we already have our next interactive poll. Just the question is, what are your biggest concerns about eventually retiring? Again, multiple choice, please select all that apply. I just launched polling. I will leave it up again for about 20 seconds. Great, so with that, let me close polling. And again, I will share results this time. And so again, at the very top, the first three, which we did have some fun with the last few of these, but the top three, these tend to be the most concerning. Paying for healthcare at over 70%, even saving enough money at about 70%, maintaining an income stream through retirement at around 70%, and then trickling down to having too much debt. And then it's going to be boring because I've already binged everything on Netflix. Yours truly in the same place too. Cool. Thanks all. Back to you, Keith and Paul.
Great, thank you. Yeah, healthcare typically tops the list there, followed by saving enough. And if we take a look at James and Barbara's asset and liabilities, their balance sheet, you can see they've been good savers between their IRAs, their brokerage account, the Roths, the 401ks. They've accumulated more than $1 million in investable assets to supplement their Social Security and pension income streams. And again, the number one focus or goal is to have that only liability, the home mortgage, paid by the time they go to retire. So I'll turn it back over to Paul, and he's going to take a look at our first pillar.
Thanks so much, Keith. So looking at the first pillar, it really just starts with the retirement income. When we talk about your retirement income expenses, you can really think of it like a barbell. After you retire, your expenses are going to be a little bit higher at the beginning of retirement, and that's because you're going to finally have the time and be able to do those things that you want to do. For most of you, it sounds like it's going to be spending time with family and friends and traveling. And what happens towards the middle of retirement is people begin to slow down, expenses come down a little bit. And then at the end of retirement, we see expenses increase just due to healthcare costs. Now, for most individuals, a good general rule of thumb is that you can live off about 80% of your pre-retirement income. So if you're making $100,000 per year while you're working, that would suggest you could probably live off about $80,000 per year in expenses in retirement. And the reason for this is a lot of expenses will begin to come down. You're probably not going to pay as much in taxes, and other expenses like dry cleaning, driving, possibly eating out, probably going to go down as well. So looking at James and Barbara's retirement income needs here, what we see is that they have a total income of about $213,000 right now. If we back out the taxes that they're no longer going to pay in retirement, which is going to be FICA and Medicare, and those retirement plan contributions that they're making to their employer-sponsored plans, And then also that home mortgage of $4,800 per month, what we find is that they should be able to live off about $120,000 in retirement, even though they're living off $213,000 today while they're still working.
Thanks, Paul. Now we're going to take a look at some expense and debt management strategy throughout retirement. So if we look at the next slide here, throughout retirement, obviously some expenses, as Paul alluded to, they're going to decrease. Others will increase, and some will be eliminated. So the big one, again, for James and Barbara, the number one goal is to have that home paid for in retirement. So that is one that will be eliminated as they transition into their retirement years. So in order to ensure, when we sat down with them, that that mortgage was paid for, we recommended the couple take $100,000 from that brokerage account we talked about earlier, and then pay down or re-amortize the remaining mortgage balance to ensure it would be paid off by the time they retire. So there were some additional tax benefits in doing this. We'll talk a little bit about that shortly. When we did meet with them, Barbara, she was a bit apprehensive about taking that much money out of the brokerage account. But after explaining we would be withdrawing funds from an interest-bearing account, earning maybe 0.001%, and paying down a debt at 3.75%, which would ultimately result in that mortgage being paid for by retirement, she was totally on board with that. So now I'll pass this back over to Paul and talk a little bit about everyone's favorite subject, taxes. Thanks so much, Keith.
You know, it's fun being a financial planner because we get to talk about everyone's two favorite topics, death and taxes. All joking aside though, most of financial planning does revolve around tax planning. Because at the end of the day, we're trying to help you keep as much money as you can in your pocket because we know it's not about how much you make, it's about how much you keep. Please do not make the same mistake that most Americans make. About 58% of all filers will pay their taxes within 1 week of the April 15th deadline. Really what this is showing is most people don't do a lot of planning around their taxes. What you should be doing is you should be talking to your financial planner and your tax advisor in the third or fourth quarter of each year. So for 2020, as an example, you would want to talk with your tax planner around October or November. And you do this for a couple of reasons. One is to get a good idea as to what your tax situation looks like. For example, if you find that you're going to owe more than you're expecting, that gives you time to make changes before the end of the year to put you in a good position for your April taxes. Unfortunately, most people don't look at their taxes until after the new year. And by then, it's past the deadline to make any meaningful changes for taxes. So let's take a closer look at the effective tax planning strategy for James and Barbara. Well, as we talked about, one of the first things we wanted to do was to pay down the mortgage. And this was important because one, it's going to free up cash flow for them in retirement. And secondly, it's going to decrease the interest that they're paying. So that's going to keep more money in their pocket over the long run. Plus they're taking the standard deduction now. So since they're not itemizing, that interest deduction was not a tax benefit for them. Secondly, we had them increase their retirement plan contributions. There's two tax benefits here. One is this is delaying taxes until retirement. So by saving more now in a tax deferred account, that money is going to help them. This can give them more money in retirement, and that should hopefully be taxed at a lower tax rate than their current rate that they're paying. But secondly, because that money is tax deferred, that's going to decrease the amount of taxes that they're paying while they're still working. So let's take a closer look at some of the recent tax law changes. In 2018, we had the Tax Cut and Jobs Act passed. It's more commonly referred to as the TCJA. And this is really important because it was the first legislation to overhaul our taxes in over 20 years. Mm-hmm. With these changes, we saw multiple changes. The first one was the elimination of personal exemptions. But to offset that, what we saw was a dramatic increase in the standard deduction. So for an individual, that deduction now is $12,400 per year. And for a couple filing jointly, that deduction now is $24,800 per year. And on top of that, if you're over the age 65, they provided additional deductions as well. With this legislation change, what we saw is more people shift from itemized deductions to standard deductions. And there's two reasons for that. The first one is we had a very high hurdle now to get over, because remember, you get the greater of your standard deduction or your itemized deductions. And the other change was there's a lot of deductions that were allowed to be itemized in the past that you can no longer itemize today. So if you're looking to itemize today, you're really limited to about 4 areas. The first one is going to be your state and local income taxes. This is commonly referred to as SALT. This is unfortunately capped at $10,000. And that is really important for people in high tax states like here in California. Mortgage interest is still potentially deductible. Charitable gifting is also still deductible. And then if you're lucky/unlucky to have high medical or dental expenses that exceed 10% of your income, those potentially could be deductible as well.
Thanks, Paul.
I'm gonna pass it over to Keith for investments.
Excellent, thank you. So if anyone's been watching the markets right now, obviously there's a ton of volatility going on, and how your investments react to volatility can have truly a significant impact on your overall retirement plan. So right now it's arguably more important than ever before to understand your personal risk tolerance for investing. So I will actually pause here, turn it back over to Chad, and we're going to run a risk tolerance assessment poll.
Great, thank you, Keith. And so again, this one we have 3 true answers at the top, and then a couple of fun ones at the bottom for anybody that doesn't know. But with that said, we just want to gauge the audience and see, does everybody know their risk tolerance today? I think the most common would be conservative, moderate, or aggressive, aka growth investing. So I've launched polling. It's on the screen. I'll leave it up again for about 20 seconds. So that, let me close polling. And I will share results again. It looks like we have a pretty mixed bag. We have over 50% of people moderate. That tends to be the most common. And then pretty split at 20 and 30% between conservative and aggressive growth, and a handful of people that's picking those fun options at the bottom. Again, let me stop share results and give it back to Keith and Paul.
Great. Thanks, Chad. So we'll talk a little bit about investment management now. I mean, you essentially have, when the markets are going up and down, 3 decisions. You can stay the course. You're comfortable within your risk tolerance and your investments. You can sell out, like unfortunately a lot of folks did in 2000, 2008. Or if you're a longer term investor, you could actually increase your contributions into your retirement plans and investments when the markets are coming down, hoping that everything comes back. But I think the most important aspect of all of this is that, number 1, you're within your risk tolerance, and number 2, you build a diversified portfolio. That's key in all of this. So on the next slide, we'll talk a little bit about that. So here's a chart stemming back to the year 2005 through 2019. Each one of these shades represents a given asset class or investment style. So as we look at this, you can see there's frequent change in leadership, so to speak, from year to year. I think one great example to take a look at on this chart is the year 2017. So in the year 2017, emerging markets happened to be the #1 performer. So if we fast forward from there to the end of the year 2018, what happened? Emerging markets went from first to worst. So no one can say which asset class is going to be the #1 performer next year. So that's why it's so important to diversify that portfolio across all asset classes, or essentially not putting all your eggs in one basket. Important stat here, more than 90% of your overall returns are derived from simply diversifying your portfolio. And once you build that diversified portfolio, it's important to stay invested. Every time I look at this chart, it's truly amazing to me. If you miss just a few of the top performing days, that can dramatically lower your return. And also, many of the top performing days follow these market dips. So in this example, if you miss just the 20 top trading days during this time period, and if anyone's curious, during this time period, there were over 5,000 trading days, your results would have been below that of the 3-month Treasury bill, which was about 1.97% at that time. Okay, So now in order to determine the type of investors that James and Barber were, we took them through a risk tolerance assessment, and their score suggested they were growth-oriented investors. So based on that, we projected their investable assets would grow at 6% on average on an annual basis. So if you look here between the growth, the contributions, their retirement accounts grew to almost $2 million by the time they were ready to retire. So this essentially, again, would be the money that would supplement their Social Security and Barbara's pension income stream. So now Paul's going to talk a little bit about how to protect these assets that you've accumulated through risk management and insurance.
So just as it's important to try and grow those assets, it's also important to protect them from the what ifs in life. And when we're looking at protection, it typically comes in one of three forms. It could be done with insurance, the use of business structure. So for example, maybe keeping a rental property in an LLC, or potentially using trusts as well. When we're looking at risk management, at the end of the day, we're just trying to help protect you from those catastrophic type of events. It's those things that we can't necessarily plan for. And one of the most common ways that we do this is with insurance. When I'm working with clients on insurance planning, there's two questions I like to ask. The first question is, if something happens, can you afford to pay the bill? If the answer is no, you probably need to look at insurance. If the answer is yes, I ask one additional question. If something does happen, do you want to pay the bill, or do you want someone else to pay the bill? If the answer is you want someone else to pay the bill, you should probably look at insurance. But if the answer is no, then you should probably just self-insure. So looking at James and Barbara's individual situation and their insurance needs, when it came to long-term care, they have such a great asset base, they chose to self-insure. And just so everybody's on the same page here, long-term care, also referred to as LTC, is common nowadays, and this is insurance that provides coverage if you're in an assisted living facility, skilled nursing facility, potentially even if you need home care. This is becoming more common these days as people are living longer, and unfortunately we're seeing a dramatic increase in cases of Alzheimer's and dementia as well. When we looked at umbrella liability for them, again, because they have that wonderful asset base, we wanted to try and provide additional protection. So in this case, we increased our umbrella coverage from $500,000 to $1 million. And umbrella coverage, just as the name kind of implies, is it picks up where the other insurance policies you may have leave off. So for example, let's say you're in a car accident and you're found at fault. Let's say your auto insurance coverage only goes up to $300,000, but you're sued and they win and they get a settlement of $800,000. What would happen if you have an umbrella for $1 million, like we recommended here for James and Barbara, is that even though the auto insurance policy stops at $300,000, the umbrella liability coverage would pick up at $301,000 and provide coverage all the way up to that $800,000 mark. So there'd be nothing out of pocket. If you don't have umbrella coverage in that situation, you would be on the hook for about $500,000. Looking at life insurance for them, they have an existing policy for James. There is no need for additional coverage given that they're trying to retire here and the house is going to be paid off. And finally, we looked at disability income planning for them, but given their age and how close they are to retirement, is actually cost prohibitive. With that, we'll give it over to Keith for estate planning.
Great. Thanks, Paul. And one thing on that umbrella policy, if you have adult children on your auto policy, that should be at the top of your to-do list. I know most of the folks that I work with in California, you can get $1 million coverage for $350, $400 per year. So you're mitigating a ton of risk for absolutely minimal cost. So that's smart insurance to have. So it's as simple as reaching out to your insurance agent or company to see what they can do for you there.
That's a great point, Keith.
Thanks, Paul. Along that same vein, having a proper estate plan, that's equally as important as managing risk throughout retirement. So we'll take a look at why that's so important on the next slide here. About 55% of Americans with children die without a will or die intestate. And Paul, maybe you can help me out here when we look at this map. Why is it that everyone has a will resides in the Western United States? What's going on in the East here?
They have great financial planners like us, I'm guessing.
Only kidding. This is for illustrative purposes only. But if you do die without a will, you're said to have died intestate. So that basically means the state will step in wherever you live, and they make all of your end of life decisions for you. So the process is public, it's lengthy, and it's very expensive. So if you've accumulated assets or you want to even leave money to a non-family member, like a charity, you can't do that without an effective estate plan in place. Some important things to consider when we talk about estate planning includes updating your estate plan if you divorce, remarry, or have children. If you have adult children with disabilities, maybe a special needs trust might make sense to ensure that your child's taken care of based on your wishes. For some folks, a revocable living trust might make sense. So anyone on the call, if you have out-of-state property, you might want to listen to this part. If you own out-of-state property and it's not titled in a trust, you could be subject to something called ancillary probate. So that means if anything were to happen to you, not only would your estate be probated in your domicile state where you live, but also in the state where the real property is located. So again, very expensive, public, a tremendous inconvenience for your beneficiaries and heirs. So now if you're someone, and many folks don't have any type of estate plan in place, maybe a great place to start the conversation at least is something called 5 wishes. So 5 wishes is America's most popular advance directive, living will also it's called. So having an advance directive in place, it's important in the event you become incapacitated and you can't make your own decisions. So simply Googling 5 wishes, you can establish that advance directive for $5. You don't have to meet with an attorney. There's no cost to you. Once you have it notarized, you're up to date. So with that being said, I will turn this back over to Paul. He's going to talk about our 7th pillar, distribution and income strategies.
Absolutely. So looking at the distribution and income sources, the 7th and final pillar, this is really where the rubber meets the road, where all the other planning comes together to put together that final strategy for you. When we look at income sources in retirement, it's really important to use what I would call a 3-bucket approach. So everyone is going to have either Social Security or some form of pension if you don't have Social Security. Aside from that, today people are more reliant on their investments to live off of in retirement than they've ever been in the past. And most people do a great job of saving in a 457 or 401k. So this is really your employer-sponsored plans. These are typically tax-deferred accounts. So you get a deduction now, money grows tax-deferred, and then you pay taxes on this money when you start taking it out as income in retirement. But aside from this, you should be using a 3-bucket approach to really diversify your taxes. And those other 2 buckets would be a Roth account, whether it's a Roth 401k or a Roth IRA, or having some form of taxable account like a brokerage or trust account. By having this diversification in tax base, these 3 different types of accounts, what that does is this provides you greater flexibility down the road. So a financial planner has more levers to pull from to try and keep your taxes lower in retirement. But secondly, we don't know what the future holds. If there's another important change to tax planning, which will probably happen at some point, having money in these different accounts provides you greater flexibility to handle that, whatever the potential change may be.
Now, Chad, do we have a Social Security poll here?
We do. So, next question. This is our last interactive poll of the day. Is what age do you currently plan on taking Social Security? Just again, to gauge the audience. I'm launching polling now. Again, I'll leave it up for about 20 seconds. Great. So with that, I will end polling, and again, I will share results with the group. So you can see, just 13% say age 62. About 30% are going to wait until full retirement age at or around age 66. So 30% say 70, and then another number of people are saying other or the day I retire, regardless of age, and then some just not sure. So I think there's definitely a plug. I'll have a link in the chat box. There will be a number of links coming over time. I already posted the 5 wishes. that will have a link to our blog where you will have links to register and watch an on-demand replay for the prior 3 webinars. So if you didn't miss Social Security or Medicare or estate planning, which goes much more in depth than Paul and Keith are doing today, that link will give you access to watch the replay. All of them are around 90 minutes, but it is only 30 minutes of original content. And then the live Q&A was about an hour for each of them as well. So definitely something to check out. Let me stop share results and I'll give it back to Paul and Keith.
Thanks, Chad.
Thank you so much.
This is interesting because I believe right now, approximately 1/3 of Americans take Social Security at age 62, and more than 50% take it prior to their full retirement age. And what we need to recognize is Social Security is a system that wasn't set up to support a 30-year retirement. So one of the questions we get all the time is, when should I take it? So what I'm about to say, it might sound a bit counterintuitive, but if you've been a good saver and you won't need Social Security in retirement, then you may want to consider taking it as soon as you can get it. Now, if you're someone you're going to rely on Social Security as a primary income source, you may want to consider delaying that as long as you can. Once you get to age 70, there's no increase in benefit, so there's no point in taking Social Security past that age. So why would I say that? Because of something called legislative risk. So in the future, could the government determine you're someone you don't need all of your Social Security benefit and then take that and shift it to someone who will be relying more on Social Security? This is very possible, and it's called means testing, and also being discussed as we sit here right now in Capitol Hill. Next year.
Yeah, and there's Keith, to bring up some valid points here with the legislative risk, and I would strongly recommend, if you didn't listen to the first webinar, please re-listen to it, as we had Yolanda on. She's spent over 40 years working with the Social Security Administration. She has some great points as well, talking about that more in depth. And really this, it is kind of interesting, counterintuitive, thinking everybody should wait. That's the textbook academic answer, is delay Social Security as long as you can based on your life expectancy, because the break even for most people is around age 80. So if you're going to live past age 80, typically better to delay. If you're going to probably pass before then due to health concerns, then maybe take it earlier would be the traditional textbook answer. So interesting take here. Definitely varies on everybody's individual situation for sure.
Oh, for sure. And generally speaking, Social Security, it's a one-time irrevocable election. So you really need to sit down with an advisor, go through your own personal situation, because everyone on this call, their situation is different. Okay.
All right, so let's take a look at James and Barbara's individual situation here. So the great thing for them is they have multiple income sources in retirement. Barbara, because she's a government employee, she does have a nice pension. They both will be eligible for Social Security. And then on top of that, they're going to have great income from the investments they have, because they've built a great asset base of about $1.9 million using the 4%. And again, the 4% rule is kind of a rule of thumb. But what it says is if you take about 4% of your assets out each year during retirement, you should be in a good spot and probably won't run out of money while you retire. And again, just keep in mind, this is a rule of thumb. It's not the perfect rule for everyone. But in this case here, looking at a 1.9 million at 4%, that would produce about $76,000 per year in additional income. So putting all this together for James and Barbara, if you remember, we'll go back at the first pillar, we had determined that their income needs in retirement was about $119,000 per year. And based on that last slide, if you added up all those different categories for income, that gives them a total income of $135,000 per year. So that's going to give them a nice nest egg of about $15,000 more than they needed, or a little over $1,000 a month. That is money that they could use to spend or save or whatever they chose to do with, but it gives them a nice cushion throughout retirement. And with that, I'm going to pass it back over to Keith.
Great. Thanks, Paul. So just to wrap things up here, we've covered a lot of material throughout the summer webinar series, including today's topic. Many of you may have additional questions. I see that some of you do right now. So it's always recommended you reach out to your trusted financial advisor to talk about financial planning topics, clarification. If you don't work with an advisor, but you'd like to talk to someone, we're here to help. So we would invite you to schedule a call or a video consultation with one of our financial planners. This is basically an opportunity to ask some of your most pressing retirement planning questions with the convenience of doing so whenever your schedule allows. So if you decide to reach out to us, what can you expect? You'll get clear guidance from an experienced financial planner, direct answers to your questions on investing, saving, retirement, taxes, estate planning, basically everything we talked about here. And then also you'll receive a 7 Pillars financial planning report tailored to your own personal goals and objectives with next step suggestions. So with that being said,
I would like, so real quick, I would like to also point out today on today's blog on our website at bfsg.com, we had posted an excellent blog about some things to consider if you're looking for a financial advisor or financial planner. What are the types of questions that you should ask and things that you should consider? And I know Chad's putting a link to the blog there in the comment section that you can go there. I would also recommend just checking out the blog if you'd like to see articles that we write about 2 to 3 times a week on these various 7 pillar topics.
Great. So let's meet the team here. This is our experienced team of financial planners. They all hold the Certified Financial Planner designation, and we all act in a fiduciary capacity. That's really important because it's always our clients' best interests that come first by law. Also, all of our planners have at least 10 years of experience in the financial services industry, and everybody focuses on an area to ensure we're able to meet the unique challenges of all our clients. So again, I'd like to thank everyone for listening, and at this point, I will turn it back over to Chad to see if we have any questions.
Thanks, Keith and Paul. Yeah, so we do. So we have a number of questions, and a reminder for everybody, I did post in the chat box, distinct from the Q&A box, a few links, one to that, the 5 wishes, one to our blog if you'd like to revisit one of the past sessions. The original brochure that you received, that had the links to all these, will also work to go and watch any on-demand replay from the prior sessions, as well as this replay within about 20 to 30 minutes after we're done today. I also posted a link. There is a QR code at the top right of the screen, but a link to a survey. This webinar series was the results of a number of surveys that we got back from clients, really all asking for these same type of topics. And we do already have planned another webinar series forthcoming as we develop some of the content for that. So with that, let me start with the first question for both Keith and Paul. What are the 401k limits for someone over the age of 55 that would be catch-up eligible?
26,000 would be the total that you could contribute to your 401k.
Yep.
Yeah, it's 19,500 if you're under the age 50, and an additional 6,500 for those over 50, just to clarify.
Thanks, Paul.
Yep. The next question is, is it wise to spread retirement savings between 401k, traditional IRA, and Roth IRA, or would it be better to focus and maximize your contributions to just the 401k or Roth 401k option?
That's an excellent question. And the answer here is going to kind of be, it depends. One of the main factors that we would look at is someone's age. If you're someone that's pretty young here in your 20s or 30s, for example, maxing out the Roth type of accounts is probably going to make the most sense because that's going to give you tax-free growth versus tax-deferred growth over several decades. If you're someone that's closer to retirement, the answer is probably going to be a mixture of both. As I talked about before, having those different buckets to use is going to be a great way to go. If you're even in retirement, there are some strategies that can be used, like Roth conversions potentially. And what that does is that takes money from the tax-deferred bucket, and you can move it into the Roth IRA bucket. But you definitely would want to work with a tax advisor or financial planner if you were to do something like that.
Right. I think that's key. It's balancing your income streams out is just like diversifying your portfolio, essentially. And Paul talked a little bit about Roth conversions. What's unique about the Roth account? At age 72, you're not required to take any money out of a Roth account. With all of your pre-tax 401ks and IRAs, you have to take out a certain amount each and every year. And if you don't, it's a 50% penalty from the IRS. So it's all about balancing out those income streams.
And so I'm going to pull the next question actually from the chat box, actually, that's tied to the last question we had. Is that $26,000 limit for each spouse in the case of a married couple?
Correct.
And yeah, I can answer this. So yeah, each spouse can save within their qualified retirement plan, 401k, 403b, 457, whatever it happens to be. If they're over age 50, with catch up to $26,000, and if they're under age 50, up to $19,500. Next question is, do both spouses need to be over age 65 to get the extra tax deduction when filing jointly?
The answer is yes. So if it's just one individual, it's going to be a deduction of $1,300. If it's both are over both are over age 65, then you'll get the full $2,600.
So next question, I'm really looking at retirement income needs. I think our example today, we looked at it kind of top down. Thinking they need 80% of the salary. Why would that be better than looking at it bottom up? Thinking about what are your expenses in retirement, less your income streams, pension, Social Security, and figure out your withdrawal rate.
So there's two ways that you can go about it. I always prefer, I like to start with the bottom up approach, which is where you take a look at your exact budget and then you try and figure out what that budget's going to be in retirement. There's a couple of challenges with that approach. The first one is you got to really keep track of all your expenses, and not every person is doing that or has the ability to do that. But secondly, we're kind of guessing based on what we expect you to spend. We don't know what habits are going to change in retirement. Some may change, some may not. For example, you may find that you're eating out more because you just don't feel like cooking, as an example there. So using kind of a combination of the two tends to be the best way to get the best accurate picture. Because if you use that top-down approach, that does give you a good ballpark as well.
So I think to clarify, I think Paul's saying that, yeah, he'd actually absolutely would prefer the bottom-up approach, but for a lot of people, it just doesn't make sense, as you're only kind of guessing at your expenses in retirement, as opposed to knowing your income in retirement and then figuring out how to live within that.
Correct.
Cool. So next question, this goes back to, we have a ton of government spending and increasing, our tax burden, potentially increased tax rates down the road. And what are your thoughts on switching, from traditional 401k contributions that are pre-tax to Roth 401k contributions, where the increase in current taxable wages would require contributions to a non-deductible IRA rather than a Roth IRA? For example, you think you're right on the threshold for that about $120,000 income that would allow you to contribute to a Roth IRA as well. If you did all of it in the 401k, then you can no longer contribute to the Roth IRA. Both are over age 55, but not 59.
Yeah.
So
go ahead,
go ahead, Keith.
No, go ahead.
Okay. There could be some real benefits to switching or focusing more on the Roth contributions. One is obviously the tax-free growth. Secondly, as Keith had talked about earlier, you're not subject to those required minimum distributions or RMDs at age 72. So that could be certainly beneficial. You just got to be careful with it, with tax planning, because if you're in your 50s, you're probably in your highest income earning years. And so you do want to be cognizant of the tax bracket that you're looking at. And what I mean by that, for example, if you're currently in that 24% tax bracket, married, filing jointly, that bracket goes from $168,000 to $321,000. Well, if you switch to a Roth account and you get above that $321,000 number, your tax bracket goes from 24% to 32%. So you want to be very cognizant of those sort of potential changes as well.
And I think also with taxes at historical lows, and that is fixed through the year 2025, by starting to contribute to Roth or converting to Roth, you're eliminating one of those variables in retirement, because the money, you have the Roth open for 5 years and age 59 and a half, everything comes out tax-free. So it really wouldn't matter where taxes are at that point. So that's another, again, diversifying those portfolio income streams.
So our next question, this goes back to kind of differences in insurance. Can you explain the differences between long-term care, umbrella coverage, and Medicare?
Sure. So Medicare, let's start there. That is essentially your health insurance once you reach age 65 or once you retire. And then long-term care helps provide additional coverage that Medicare does not provide. And that's going to be covering costs specific to assisted living, skilled nursing, or potentially some in-home care. So a common example there would be if you have Alzheimer's and you have a caretaker at home, but you have someone coming in a couple days a week to provide additional care to help support the family. That may not be covered by Medicare, but long-term care could pick up that cost. As an umbrella insurance is a separate type of insurance. It's what's called property and casualty. An umbrella is used in conjunction with your auto policy and your homeowner's policy to provide proper protection on those assets.
And I think, and Paul, you've had this same experience, I'm sure. The long-term care thing is important. It's really complex and expensive to shop. The average age we enter those facilities in this country is 84, and a typical stay is 2.7 years. So do you have $250,000 with inflation to cover that cost if it were to happen to you? Because unfortunately, we see too many folks that can really erode a retirement nest egg. And Paul mentioned Alzheimer's, and I think that the average stay there is like, what, 7 years? So that's important to plan for if you have history in your family, something to address for sure.
Yeah, and there are resources out there like here in California, we have a form of Medicaid called Medi-Cal that can be used to kind of help pick up some of those costs if a family runs out of money or is running low. And then with the long-term care too, if that is something that you're considering and to take a closer look at, there's two schools of thought. One is get it as early as possible. The reason there is the younger you are, the cheaper the coverage is going to be for life. The other school of thought is wait until about age 70. There's some risks here where in case you needed this coverage before then, or you may not qualify at age 70. But the thought there is even though it's more expensive, you're paying on it for a shorter period of time. Definitely something you would want to talk with a professional more about if that's something you want to take a closer look at.
For sure.
Great. So next question is it good to have your adult children on the same auto policy if you already have umbrella insurance?
Keith, do you want to answer that?
If you have the umbrella policy, the coverage, I think you're safe. That's why I had mentioned that earlier. If you do not have an umbrella policy in place, that's an issue. Like that again should be at the top of your to-do list. But having umbrella coverage, and it depends on the investable assets, what your net worth is, what those limits are. So that's again an it depends answer, but generally speaking, you have your kids on the adult kids on the auto policy. If you have the umbrella in place, we're good with that from a financial planning perspective because you want to preserve your assets if anything were to happen.
So next question is, if I pay into an employer-sponsored retirement plan, can I also add it to an outside Roth IRA?
The answer is yes, as long as your income is under a certain threshold. So for example, if you're married, filing jointly, what's called your modified adjusted gross income would have to be under 196,000 to be eligible to make Roth contributions. If you were eligible, you would then be able to make $6,000 into a Roth IRA if you're under the age 50. If you're 50 or older, you can contribute $7,000, and that number is per family member. So if you're a married couple, both the husband and wife would be able to contribute $6,000 or $7,000 respectively.
And so to kind of add to that too is, we mentioned income limits. Those do apply to Roth IRAs. They do not apply to a Roth in a 401k or employer-sponsored account. So in the employer-sponsored account, you can typically contribute up to the maximum limit. So 401k, 19,500 or 26,000, all in Roth assets, regardless of your income.
And
that limit
yeah,
only IRAs.
And for simplicity, Chad, I would add to that. If you're eligible for a Roth account with your employer, I would certainly max that out first before looking at a separate Roth IRA account.
Yeah, it's definitely more convenient. One thing to recognize in doing that, as I mentioned earlier, with the Roth IRA, there's no required minimum distribution. If you keep the Roth in plan account at your employer and you leave, you turn age 72, you have to start taking distributions out of that. So that's the big differentiator between the two.
All right, so our next question is, how long should I plan for long-term care insurance?
Well, there's different schools of thought. If you have coverage of 3 years, an inflation rider on the long-term care policy, you don't need all the whistles and bells, and we're not trying to cover 100% of the cost of long-term care, but to more supplement it in the event anything were to happen, because it can quickly get very expensive, right, Paul?
Absolutely. I would strongly recommend, if this is something you want to plan for, definitely work with a financial planner or another professional on this, because this is really going to come down to what your asset base looks like, what your family health history is. And like we talked about earlier, you know, are you of the philosophy that it might make sense to buy it now while you're young, or wait until older and try and buy it then?
So next question is, with current Social Security finances and anticipated 20 to 25% haircut in the next 10 to 15 years, should financial planning factor in that benefit reduction?
So going back to the conversation we had with Yolanda on the first webinar series, the expectation is Social Security is a social benefit. So we expect it to be around there in some form. I anticipate a haircut of 20 to 25%. I'm not sure where those numbers are coming from. There could be a lot of different legislation. There's a lot of different things being talked about in legislation. One of them was the means testing, as Keith mentioned earlier. Other things were mentioned was maybe a one-time haircut of 13% for existing people that are getting Social Security benefits. So I don't know if I would say 20 to 25% haircut. It's certainly something that can be focused on the financial planning process. If you're within 10 to 15 years of retirement, I would expect to include Social Security in the financial plan of some sort. And Keith, anything you want to add there?
No, I'm good.
Great. So next question is, if I were to confer with one of our financial planners, are they all specific to California, or can you work with all states? Think, you know, Northeast, New Jersey, New York,
Yeah.
etc.
We have clients across the country, and Paul, maybe you could lend some insight to here. It doesn't have to be exclusive to California.
Sure. Yeah, no, most of the financial planning strategies that we discuss, it doesn't really matter where you live. The only two caveats to that would be if we're doing tax planning and you live in, and let's say you live in Massachusetts, well, then we have to factor in your state income taxes. So that could impact planning a little bit there. And it also impacts it from an estate planning perspective, because if you live in one of the 13 states that have state estate taxes, then that's going to change the planning recommendations as well a little bit.
Cool. Next question, pulling this from a chat box, is what are the typical fees and costs associated with creating a will? And so I think I can pull that answer from the estate planning webinar we did just last week, you know, talking with an estate planning attorney on the line, you know, helping facilitate. And it really depends on your situation. You know, I think there's a lot of websites you can go and do like something really basic for free. And then if you want to get a more complex situation, you're looking at upwards of, you know, $40,000 to $50,000 if you end up with a, you know, full estate plan and trust and all that stuff. So really it does range on complexity from zero for a very basic, you know, something like LegalZoom, assuming you don't need a lot of different things or a lot of complex issues, to upwards of tens of thousands of dollars, you know, for a more complex situation.
Yeah, most comprehensive estate plans probably run $1,500 to $2,000 to $4,000 or $5,000 would be kind of the average range, I would say.
And so next question is on the same lines, but a little bit different, not about cost. Is it recommended to have both a living will and 5 wishes? I mean, are they the same thing?
They're essentially the same thing. If you already have a living will in place, then there's really no need for 5 wishes. What I was looking to do was give a solution to anyone who doesn't have that in place. Only 33% of Americans have a living will in place. And unfortunately, firsthand, we've seen a lot of folks, tightly knit families, something happens, someone becomes incapacitated, there are no instructions or directives in place. That can be very detrimental to the relationship on the family. So at a bare minimum, having something in place, whether you already have the living will in place or you go the 5 wishes route, is highly recommended.
So next question is, if you have significant equity in your house and downsizing would allow you to eliminate the remaining debt and get additional cash, Is that something you would recommend? And if so, when would be the best time to do that, at or near retirement?
So if you have a lot of equity in your home, that certainly can be used as another asset to help provide income for you in retirement. There's a lot of both qualitative and quantitative issues here to consider. And what I mean is this: if you've lived in the same home for 40 years, even though you can downsize, if you can afford to live there, I would actually say why not if that's where you want to stay. So just because you have equity and you want to take the money out, that may not be the best solution if you can afford to stay there and that's your preferred place. Now, if you're looking to maybe relocate out of state, or you definitely know that you want to downsize because maybe you don't want to do the upkeep or whatever the case is on the home, then having that additional cash can definitely be good to help with funding your retirement goals.
So our next question, and this is from someone with a 457 plan instead of a 401k plan, is can I move my existing 457 contributions into a Roth plan? I'm 60 years old.
Would that be an employer-sponsored plan?
Yes.
Yeah, you can separate the contributions between pre-tax and post-tax. Post-tax meaning the Roth. You just can't exceed that total contribution we talked about earlier. So the 19,500, or if you're over age 50, 26,000. So that's a balancing act there as well. So depending on your situation, it may or may not make sense. But that's something on a one-on-one basis we could definitely talk about.
I think something to talk about too, Keith, to add is doing it sounds like this would be a Roth conversion. And if you were to do that, what are the potential tax implications for this year?
Then you would be taxed at your ordinary income tax rate. So it's like you're earning the money. Normally when we're doing these conversions, and Paul, you can chime in here, it's a multi-year approach. Taking $100,000 out of a 457 pre-tax and putting it into a Roth most likely would not be advisable, but more spreading out that tax liability and keeping you within your same tax bracket, I think, is paramount here. We don't want to kick you up into the next bracket and increase your tax liability.
Yeah, it's just using what I call a fill the bucket approach. So whatever tax bracket you're in, like he said, we just take you to the upper limits of that bracket without trying to increase you into the next tax bracket. And that typically takes multiple years to do all that.
Yeah.
So our next question is about some of the calculations going through our case study today. It wasn't clear if those accounted for inflation, but regardless of that, really, how should inflation factor into your retirement expense needs?
So inflation is one of the biggest concerns when we're doing retirement planning. It's absolutely something that needs to be considered in it. What we were showing today for simplicity was everything in today's dollars. When we're doing the actual financial plans, we do take into account inflation over time.
Yeah, I think one thing to add to that too is inflation tends to be higher in some of the areas that you might spend more in retirement, like healthcare, and tends to be lower in some areas you might actually spend less in retirement. So inflation definitely a huge consideration in doing financial planning.
Absolutely.
Okay, and so next question is talking about reverse mortgages. When does a reverse mortgage make sense and when does it not? And are there other ways to tap into home equity during retirement that are recommended?
So a reverse mortgage typically isn't something you lead with. That's kind of something you kind of fall back into when there are no other alternatives. Is typically how most people end up with a reverse mortgage. There really aren't any other ways to tap into home equity that I'm aware of. If you're maybe doing like a $50,000 home remodel, you may just do a home equity line of credit and then pay that off while you're retired. But other than that, there really is another way to tap into the home equity that I'm aware of.
Right. Last consideration, I think the regulations still to this day surrounding some of the reverse mortgages, it's still convoluted. So if you're someone who's single, you have no family, you want to remain in your home, and you doesn't matter who you're leaving an estate to, it might make sense, but that's a consideration that you talk about if you have no other options, in my opinion anyway.
So the next question I'm pulling from the chat box again, it goes back to something we talked about earlier, the Roth and the required minimum distributions. So given the explanation you gave about required minimum distributions from the Roth 401k after 72, if you keep it in the 401k, Does the distribution requirement disappear if you roll those Roth 401k assets into your Roth IRA? Great question.
It does. But again, keep in mind here that Roth IRA that you roll it to has to be open for 5 years and age 59 and a half before you pull any money out of it. So if you're 5 years or so away from retirement, it's most likely advised that maybe you set up that Roth IRA just so you get the clock ticking. I mean, you can, once you fund the account, that's when that starts.
So next question is, we talked about tax rates throughout the presentation today. Is that specific to just federal, or does it include any state taxes?
So the examples on the taxes we were talking about was just federal. State taxes are something you would want to consider as well, for sure.
Yeah, I think those, we have attendees on today's call from across the country, so we didn't want to get specific. It really depends if you're in California or New York, really high taxes. If you're in Arizona, Texas, Florida, very low taxes. So definitely something to consider as you look through your financial plan. So next, it goes back to kind of the traditional versus Roth conversation. Are there any benefits to switching your IRA from traditional to Roth if you're close to retirement? I think within 1 year. And then if yes, is it better to switch before or after retirement?
So if you're close to retirement like that, there's certainly benefits of doing the Roth conversions. Let's say you're going to retire at 65 and you live till age 90. That's going to give you 25 years of tax-free growth. Plus, from an estate planning perspective, when your heirs inherit the money, they'll inherit that money tax-free in a Roth, or they'd have to pay taxes in an IRA if they inherit it. In terms of the timing as to when to do the conversion, probably going to make the most sense to wait until after you're retired. Hopefully your income bracket, your income tax bracket drops then, since you'll no longer have the income from your employer. So that might make it more tax effective to do that conversion at that time.
Great. So with that that was our last question for today. So take a moment to kind of thank everybody for attending today's webinar. I'm going to give it back to Keith and Paul for some closing remarks.
Appreciate everyone's time. Times are uncertain right now. If we're here as a resource for you, if there's anything you need, we did have our contact information up there. You can email us at financialplanning@bfsg.com if you need anything. Otherwise, thank you folks for tuning into this summer webinar series. Much appreciated.
Yeah, we really appreciate it. I know 4 weeks at the same time is a large commitment. We thank you guys that have done that or listened to the replays. And we hope to see you on our future webinar series.
Great. Thank you all.